Hey there, and welcome. If you own a house in India, you know that figuring out the tax on it can be, well, a little confusing. Today, we're going to break it all down. Let's dive in and finally make sense of these numbers.
So you own a home. Awesome. But then come the tax rules. I get it. It can feel like a total maze. But here's the thing. The secret behind the calculation is actually surprisingly straightforward, and we're going to unlock it right now.
All right, so the very first thing you got to wrap your head around is this. Your tax isn't actually based on the rent money you collect. Nope, it's based on your property's earning potential, what it could have earned during the year. And that's a huge difference, right?
And this idea, this earning potential, it has a name, the annual value, or AV. Just think of this as the magic number, the cornerstone of the whole calculation. Everything else we talk about is going to build on this one figure. So how do we find it?
How do we actually find this annual value? Well, it's a really straightforward two-step deal. Let's walk through it.
Okay, look, the formula is super simple. First, we figure out something called the gross annual value, or GAV. Then, from that number, we subtract any municipal taxes you paid. And what you're left with? Boom, that's your annual value, the AV.
Okay, so you're probably asking, what on earth is gross annual value? It's just a simple comparison. The tax authorities look at two things, the rent you actually got and the rent a similar property in your neighborhood could get. Whichever one is higher, that becomes your GAV. It's all about finding the property's true earning power.
So to get to our final annual value, it's really just that GAV minus the municipal taxes. But, and this is super important, notice the word paid. You can't just deduct what you owe. You can only deduct what you've actually paid during that financial year. That little detail matters a lot.
All right, so we've got our annual value. Now comes the good part, the part you've been waiting for, deductions. This is where you can seriously lower what you owe. And there are two big ones you absolutely have to know about. First up, there's this awesome automatic deduction, a flat 30%. For any property you rent out, you get to slice 30% right off the top of its annual value. This is supposed to cover things like repairs and upkeep, and the best part is, it doesn't matter if you actually spent a dime, you just get to claim it. Now that 30% is great, don't get me wrong, but let's be real. For most of us, the biggest expense by far is the home loan, right? So how does the interest you're paying on that loan fit into all of this? Well, that brings us to our second and usually our biggest deduction.
And this is where things get really interesting, because it depends on how you use the property. If it's a home you live in yourself, the interest deduction is capped at 2 lakh rupees a year. But if it's a property you rent out, there's no limit. No ceiling at all. You can claim the entire interest you paid. That's a huge deal if you're a landlord.
So yeah, let's just burn this number into our brains. For the home you live in, the magic number for your home loan interest deduction is 2 lakh rupees. That is one of the most important and valuable deductions you can claim as a homeowner, so don't forget it.
Okay, but life isn't always so neat and tidy, is it? You're probably thinking, well, what if I own more than one house? Or what if my tenant stops paying rent? Let's tackle some of these really common what-if situations.
So here's a really common one. The law says you can have up to 2 properties listed as self-occupied where the annual value is 0. But what if you have a third? Well, even if you live in it, the taxman basically says, nope, we're going to pretend you rented it out. They call this deemed to be let out. This means you have to choose your 2 self-occupied properties very carefully to save the most tax.
And what about that nightmare scenario? A tenant who just doesn't pay? The good news is you don't have to pay tax on money you never got. But you've got to tick these 4 boxes. It has to be a legitimate rental, the tenant has to be gone, they can't be living in another one of your properties, and you have to show you've made a real effort to get your money back.
You know, your choice of tax regime, it's not a small decision. It's a massive one, especially for property owners. Just look at this. Under the old regime, if your property makes a loss, you can use that loss to reduce your other income and even carry it forward for 8 years. But under the new regime, poof, gone. You can't do either. That's a game changer for many people. Okay, all this theory is one thing, but let's make it real. Let's put all the pieces together and crunch some numbers with an actual example. So let me introduce you to Priya. She owns 3 different houses in Delhi, and she uses all 3 for herself. None of them are rented out. And right away, based on what we've just learned, you know this is going to be an interesting tax situation.
So here's the puzzle for Priya. The law says only 2 get a pass with a 0 annual value. Which of her 3 houses is going to be taxable? Well, the great news for her is she gets to pick. And that's not just a small choice, it's a strategic move to minimize her tax bill.
So Priya, being smart about it, chooses her 2 properties with the highest rental potential as self-occupied. That leaves house 2 to be taxed as deemed let out. So let's just walk through the numbers. Its gross annual value is its fair rent of 2,20,000. We take out the 20,000 in taxes she paid. That gives us an annual value of 2 lakhs. Then comes that automatic 30% deduction, which is 60,000. So the final taxable income from this house is 1,40,000 rupees. See how that works?
Woo! Okay, that was a ton of information, I know. So let's just boil it all down to a simple checklist. These are the absolute must-know points from everything we've covered.
All right, if you remember nothing else, remember these 4 things. 1. Always start with annual value, not the rent you collected. 2. Grab your 2 big deductions, that 30% standard deduction and your home loan interest. 3. Remember, you can only claim 2 properties as self-occupied. And 4. The tax regime you pick, old versus new, makes a huge difference.
You know, at the end of the day, this isn't just about paying tax. It's about knowing your stuff. It's about being in control. When you understand the why behind the numbers, you can make way smarter decisions for your future.
So I'll leave you with this question to think about. Now that you know how it all works, are you really making the most of your property's tax potential? Are you sure you've got everything set up in the best possible way? Thanks so much for tuning in.